Welcome to the Real Money Show, the number 18778 Silver, the website guildhallwealth.com. Thank you for joining us this week. My name is Jeremy Wiseman. I'm joined by Jerry Correa. And it's been a great week in the markets. If you're looking to get involved, make sure that you know the number 18778 Silver and the website guildhallwealth.com. Jerry, last week, price of gold ended the week at $20.83, which was already up for that week. As we're taping the show, we're at around 2,180, so it's up about 5% in a week. Which is not the standard when you see a big move in gold, right? Usually they kind of, at about 2%, it gets capped at some point. Mm-hmm. So you don't often see big moves like this.
Like sustained moves.
Is it the start of something that we're going to see more of? Silver last week, we were closing at 23.16, which I believe was up something like 40 cents on the week. We're now trading at 24.38, so we're up well over $1, and that's also 5%. So very good week in the metals. Very quickly, Jerry, what was your observations on the week? What were people saying? What was the vibes?
Yeah, the big move happened, and the big move in precious metals started on the back of a lot of banking risks. We saw last week New York Community Bank Corp out of New York plunging more than 30%. The stock was then halted. That was Friday's pre-market, so that it soured the mood right off the bat, identifying material weaknesses, not just in that bank, but other banks. And then more so, it was more of the Federal Reserve. I think it was Christopher Wallen, Fed member last week. He basically said the Federal Reserve will be introducing Operation Reverse Twist. In other words, the Fed wants to reintroduce more quantitative easing because the U.S. economy really is just in tatters. And guess who really caused that? A lot of high interest rates squeezing commercial banks. It's all interconnected. And this is all interconnected and leading towards what we saw this week. The Federal Reserve, a Fed chairman testified. He had 2-week testimony this week in front of the Senate Banking Committee. A lot happened there, and it's all alluding to rate cuts. That is the key for us here at Guildhall and people who are looking at precious metals. The rate cuts, that is upcoming. That is the key.
Well, that's certainly the big topic that everyone has bated breath regarding, and we'll get into that a little bit later. We'll also talk about reserve requirements for major banks. That seems to be another big topic that probably absolutely nobody is talking about, Jerry. We'll also get into why this new trend of seeing the mega rich, the people that you all know as household names, are all of a sudden pulling massive amounts of money out of the stock market. And as well, we'll talk about whether or not gold is too expensive here. Finally, let's start with, because I think this would be a great way to get a grounding for the rest of the show, which is, let's talk about Extr's Pyramid and Exter himself. Jerry, what is Extr Pyramid and who is Exter? And why does it matter?
Yeah, so Extr's Pyramid, it's one of the go-tos that we look at what it is. It's an inverted pyramid, and it's an inverted pyramid that is layered with asset classes that range from higher risk, higher risk weighting, down to a low risk or no risk asset category. At the top, you're going to find things like derivatives of this pyramid, very risky asset classes, down to lower and lower risks of default. So it goes down to commodities, going down to bonds, government T-bills, paper currencies, and at the very bottom, you have the gold market, which is a finite market, very solid, very liquid, which is why it's the foundation of this inverted pyramid.
So Exter created this pyramid. He puts gold at the bottom of this inverse pyramid. So it is the peak on which this inverted pyramid is sitting upon, saying that it is the least risky asset. It is a no-risk asset. Why did he put it there, and who is he?
He put it there for some solid reasons. He saw that how money flowed. Yes, first it flows from the top, and then as risks persist in the market, it then flows into less and less risky, more and more liquid asset classes.
So this is kind of essentially an illustration of gold as a safe haven.
It definitely is. It highlights why gold is considered, according to Extr's pyramid, power money, because it cannot be printed out of thin air, it's finite in reserve, and it can be liquid. And therefore, that is the reason why it's been reclassified, Jeremy, as a Tier 1 capital asset, which we're going to get into a little later.
Yes, which is why we're talking about it now.
Yeah, John Exter, he was actually the first proponent, the first person who argued for the 10% rule in precious metals. But firstly, John Exter, he's a late American economist born in the early 1900s. He was a member of the U.S. Federal Reserve, and he was a vice president of the Citigroup, and he also founded the Central Bank of Sri Lanka. So this guy, he was all about, expanding the central banks, but he was the one who drafted, when we asked the question and deciding how much gold and silver should be in one's portfolio, it definitely should be a personal decision. But the 10% rule came from somewhere and actually came back from John Exter. But this rule is brought to us today. A lot of financial planners and consultants are still using this 10 to 15% percentage into physical precious metals. This was a rule that was set early in the 1900s. So I think this is an outdated rule. What are your thoughts on that?
Well, first of all, I love digging through history and finding out where these things that we think of standard and just common wisdom, where it actually came from, right? I love learning about that. So to find out that he was the one who was recommending it. My question about that, though, is, was he recommending it for central banks? Was he saying that central banks should have 10%, or we're not quite sure? We just know this is the first time we can witness where an entity, in this case a person, a central banker, was recommending 10% gold as part of your holdings and wealth.
Well, at that time, it was a part of the central bank. It was a part of the treasury. The gold was used to back up the currency at the time, so it was the norm to include gold. It was a part of the conversation. It was a normal part of diversification. And remembering what diversification is, there's asset classes that move in the opposite direction from one another. So the more diverse or the more inversely correlated your investments move from one another, the more diversified you are. And with the studies with this 10% rule, we were able to draw up the studies with the Ebbets Associates, and that proved actually through ratios, Sharpe and Sortino ratios, that including 10 to 15% actually improved your overall standing in your investments. Okay, so
Ebbets and Associates, they came out with a report, I think it was in 2010, 11, something like that, where they basically tested the theory, and it proved true, because essentially if you look at gold as an example, it does quite well and fine during good times.
Yep.
It does even better during bad times. And so if you're going to have an asset like that in your portfolio that has no risk, it is going to give a boost to everything else. Obviously, we're not advisors. Talk to those you trust, but we're just talking about historically where this concept comes from. And now let's just test that a little bit, because okay, back in 2010, when this Ebbets and Associates came out, give or take, it was around that time. All right, so that was 10, 12, 13 years ago. Does it matter today? Does it still work today? Maybe Exter coming out with this in 1930, it mattered then, but gold's a relic, Jerry. Why does it matter today?
Well, it's still very relevant, even after the closure or the suspension of the gold standard being removed in the 70s. Gold is still very relevant. Gold is an asset class that is one of a kind, according to the central banks of all central banks. The Bank of International Settlements classified gold as being 0% risk weight, the best collateral that you can have on a balance sheet. And therefore, this is the reason why what we're seeing, being testified this week before Congress, before the Senate Banking Committee, the chairman, Federal Reserve, Reserve Chairman Powell, was questioned and really drilled on the topic of Basel III rules.
So when did Basel III say that? When did they say that this is a Tier 1 asset?
That was back in 2000, I believe 2009. So it happened a while ago, and it was something...
In the wake of 2008?
Yeah. Just right after the 2008 crisis. It was in response to that. And then there was further provisions that were added. So they keep adding provisions to Basil III rules. The latest one being in 2023 in response to Silicon Valley Bank.
So almost 80 years after Exter creates this concept of the pyramid to demonstrate to central bankers how the money system works and flows downward as risk, as we say, turning risk off, that gold becomes the ultimate safe haven because there is no counterparty risk. It is the least risk asset out there. It is risk-free. Almost 80 years later, you have the central bank to central banks, the Bank of International Settlements, coming out and saying, this is true. It is as true today as it was 100 years ago and 200 years ago and thousands of years ago. It is money. There is no risk in holding physical gold. Is that correct?
Oh, 100%. This is the biggest story, Jeremy. This is bigger than, the flashing lights of various other investments that you could be jumping on board. Follow what the big money is doing. Follow what central banks are doing because they don't lose. They're not in this business to lose money. The countries are not in the business to fall by the wayside. They're in the business of pursuing growth and togetherness, and I think peace is we're going to be seeing that happening very soon. But a lot of things are moving with regards to gold and solidifying partnerships.
So, if you want to hold physical precious metals in a portfolio, Guildhall can help you with that. We help clients to acquire it directly. That means no counterparty risk. You're buying that asset, that end user asset. You take it home, you self-store that product. Same thing with silver. We do offer storage as well, which is outside the banking system, fully allocated, fully segregated. You can go and personally audit your holdings, take delivery anytime. We utilize Brinks for that storage facility. You get your own sub-account. So that's fully liquid, but fully secure and insured. Finally, you can also do this within a registered account. So if you're looking for places where you can readjust your portfolio and you want to have some physical precious metals in there, you can do that in a registered account. And you'll call us. We'll walk you through exactly how that works. The number, 18778-SILVER. The website, guildhallwealth.com. This is a necessity. It's a must at this time. Risk is going to become the catchword as we start to see everything fall apart. So we're going to talk about that more on the other side of the break. Again, the number 18778-SILVER, the website, guildhallwealth.com. It's the Real Money Show on 640 Toronto. Welcome back to the Real Money Show, the number 18778-SILVER, and the website, guildhallwealth.com. We're going to get into Chairman Powell and his comments this week and what that means for the markets, as well as reserve requirements, which is going to be huge going forward for physical precious metals. But let's just complete the topic on Extr's Pyramid and holding 10%. Because, Jerry, when I look at the Abitz and Associates, I think about that when they wrote that, it must have been just before quantitative easing, because had they realized that they were going to head into a period of extreme financial and monetary experimentation, they probably would have said, hey, listen, if stocks become overvalued by this percentage, you're probably going to want to hold more precious metals, because they weren't taking those type of concepts into consideration. Now, they're not the only ones talking about 10%. I'm not the only one mentioning this idea of hedging more if there's more risk in the market. There's others doing that too.
Yeah, again, we're not advisors, but what we have noticed over the course of the last few years, especially, the majority of our clients are holding roughly around 15% of their assets in precious metals. Obviously, some are higher. And I want to just bring to our listeners' attention some of our mentors, and one of them online is Egon Von Greers, of Matterhorn Asset Management in Switzerland. He writes that the composition of the portfolio should depend on, obviously what you mentioned, the personal situation, risk tolerance, and what's going on in today's economic and geopolitical context. Back in 2002, Egon Von Greers, he recommended 50%. Clients should be holding 50% of their assets in physical gold because of a world that was, back then, rout of government deficit and runaway banking credit crisis.
And they wouldn't have, and if they had done that, they wouldn't be in a bad position at all today. Gold's up I don't know what it is in euros, but I know in Canadian it's up over 450%. So take a couple years off of that, you're still up well over 400% on half of your portfolio if you had taken Egon's advice.
Exactly, and he is recognized as one of the world's foremost gold respected experts and analysts. But today he sees the situation as we do, a lot worse. Wealth protection today is the most critical topic of conversation for not only his investors but the investors over here overseas in Canada. Many investors ask, what percentage, some who are concerned about the financial system, banking system failures, banking systems going down, have 60 to 100% of their portfolio into physical precious metals, together with some silver, because we often tend to gravitate towards gold more in our conversations, but do not forfeit silver, as a recent study done by Oxford Economics recommends putting 6% of the investment portfolio with gold. So if it's 15% gold, then you need 6% as well. It becomes about a third of the overall portfolio, Jeremy. You're in great shape to position for protecting from the onset of these systemic risks, the cascading of these dominoes, but to prevail in the next stock market or the next bull market in precious metals.
And, at the end of the day, we're talking about building up a comfort level to these things. When you just take flat advice, you should have 10%, you should have 15%.
But why?
It's one of these things where it's just, there's a standard rule, and if I don't study or look into it, I could just go by this generally accepted thing. What we really espouse at Guildhall, how's your water bottle? Sounded empty. What we really espouse is crawl, walk, run, meaning if you've never been involved in this market at all, just get your feet wet. Sometimes there's a need to rush. Maybe you feel very concerned about what you're seeing in the markets, but you still have to take your time, get a sense of what this market's about. And what we find is that when people do that, and they take their time to get into the market and understand and have conversations, and I'd love to talk about, at some point, if we get time, all the conversations I've been having with people this week, that they tend to find their way of what is the right amount for them, and that it might be starting off by building up a little bit of a cash portfolio. Maybe it becomes building up a portion of their stock portfolio against physical metals as well. And then maybe they start to think, okay, well, maybe I should build up a certain amount against my net worth. And it's really great to see how clients come to their own conclusions. We're here to help. We're here to bring other sides of the conversation and let them understand, well, here's the pros and cons and the psychology of it as well. We really get involved in those type of conversations, but we're never pushy. And I always find that clients find their own way and find what's right for them. And I know you mentioned that it, generally speaking, is about 15%. I find it a lot more. I find that people are more, that we have clients who have well over 50% in this market, and that's a comfort level. For myself, for instance, I would be comfortable having my entire net worth in gold, and I would have zero issue with that because I understand it so well. And also, I personally do a lot of the mining investing, which is the complete opposite end of the spectrum, right? Yeah. Gold is the least risky and mining is the most risky. Mm-hmm. And that's okay. And then you split it up in between. But I digress. That's what we help people do. And I always find that when people hold the physical, they can get a sense of how it is. There is no risk to this. Now, they ask a question. They go into hypotheticals. What happens if it's confiscated? Because the only way of a non-risk asset being a risk to you is if someone steals it.
That is a topic of conversation that comes up a lot about confiscation. Silver, we've never seen historically silver being confiscated. Gold, on the other hand, that happened at a time when there was a need to back up the currency, with gold having the gold standard still in effect back in the 30s, the 33 Gold Confiscation Act. Because back then a lot of Americans owned gold. Roosevelt needed the gold, offered a value of cash for them to volunteer the gold back. It wasn't a mandate, or not even a mandate, a law that was put into place
But
for you to
also-
volunteer your gold back.
But also, there was a trust in government back then.
there was a lot more. much more so.
Today, the way you confiscate someone, the real confiscation was going from $25 to $35 revaluation or revaluing. Today, the way you need to do it is to create incentive. Jerry, I'll give you $3,000 for your gold,
Oh yeah.
right? Hey, we're printing the money, which goes to the question: why would anyone need to confiscate today?
There's so many
They're already
taxes.
taking 30-40% of your taxes. Then you get 13% on top of that. They put inflation at, even if they were right, 2% a year. That's 20% every 10 years loss of your purchasing power, and they want you to accept that.
And there's more.
They want you to
taxes.
accept that as just a normal. You should be losing 20% of your purchasing power every decade. That's ridiculous. But now, of course, everybody sees it.
Mm-hmm.
It's out of the bag, and now it's something like 10+%. Right? If you have a variable mortgage, it's higher than that. So the fact is that they're already got you for 60-70% of your net of your value that you bear in the market. You're a slave. I'm a slave. You're a slave. We're all debt slaves now. And then the government goes out and spends money that they don't have, and then they create a whole bunch of jobs and say that the labor market's going up. Well, who's paying for these jobs? They only have a tax. There's only so much tax, and they're spending way more than the tax. And then they want universal basic income.
Another one.
And then people who are getting their universal basic income checks are going to wonder why the price of milk is going up. It's because you're getting free checks.
And you gotta pay
and
the-
someone's got to pay for that.
3% carbon tax. Then the other one coming up in
So,
April the 1st.
but my point is that the government seems quite content to just print money, and they haven't had a need for gold for decades.
That's the mechanism.
If you're holding gold, then they would have to actually take it from you, and then you would know it's theft. But they want inflation to do it so that you don't know it's theft, and they want you to think socialistically about pay your taxes so we can. Oh, okay, well, we actually aren't really fixing the roads. Well, you got to pay your taxes to. Well, okay, we didn't really fix the healthcare system. But you got to pay your taxes because we're fighting something else, and you got to send money all over the world. No, you got to stop that. You have to figure out how you're going to protect your wealth. And the best way to protect your wealth, as another central banker said, which is Alan Greenspan, is the way to stop theft of inflation through theft of your money through inflation is to actually own gold. He said that.
Yes. In light of all of the taxation that's coming out, and people are just not aware of it. But we are seeing that the taxes are going up. The cost of living is going through the roof. And this is a very important conversation that you're having right now, is bringing up this topic of theft, because that's what it is. And are we going to see a gold confiscation? The easiest method of taking from the people is all digital. Your money is just digital means sitting on a bank ledger. It's not, it's not actually physical wads of cash that you have sitting in a bank. These are digital assets. And to suggest that they're going to go after Canadians who own very little gold, less than 1% of the population owns gold. It would be a very futile
people
move.
don't own much
don't-
anymore of
no.
anything because they're worried about someone stealing it from them. The World Economic Forum already has you. You are one step away from eating bugs because you don't want to own anything. And then the other thing about that, honestly, is at what point do you stand up? At what point do you say, no,
Oh, we're there.
I'm not going to let you take it. I'm not going to let you take it. You're already taking 35-40%. You're already taking 13% on top of everything. You already raised the property tax. You're already adding carbon taxes, and yet you're shipping stuff up from Mexico. They don't pay it. You're already letting all these people in and weaponizing immigration against us. When do you stand up and say, maybe I'll say no to this?
Well,
right?
This is what's happening. Why do you see, Costco selling gold, and why is there so much demand? The people are waking up to the fact that this is theft, and I want to fight against the theft. And the way to do this is get my money out of the system and into a system that is outside of the digital SWIFT banking system.
And what happens when they try to take away guns in the United States?
Good luck.
People go out and they buy what?
Buy more.
Yes.
And ammo.
So imagine
And bunkers.
if the one country in the world, Canada, that everyone looks at our prime minister as an absolute joke, and so does 70% of the population, by the way. What would you think would happen if they decided that this guy This guy, you think this guy is going to actually be full out fascist? This guy is such a smarmy, let's do everything on the sly, quietly.
Gray area.
And then when they want to investigate it, we'll just shut down the investigators and I don't know how they do it. They're doing it though. But to actually be fascist,
No.
actually real fascist and somehow get the military on your side with
Tanks
that.
on the street? No.
I don't think so. I really don't think so. But if that's what you're worried about, then don't own anything.
That's right.
Then don't own
Yes.
anything. And if that's how you're really going to feel, then you should sell your house too. Because if they're going to take that asset of gold, they're going to take all the other assets. You're already gone. That's the problem with these hypotheticals, by the way.
Because they can keep going.
But
yeah.
I appreciate the hypothetical in the sense that what you're doing is you're testing something at the extremes.
You got to poke holes in things.
You're testing something at the extremes. A stock can drop to zero. Gold can't drop to zero. Silver can't drop to zero. So how can I lose? If my stocks drop, I can blame my advisor. I can say it's someone else's fault. I can say it's a glitch. I can say it's a 800-year something happened in the markets that comes along, blah, blah, blah. But how would I lose with gold? Well, I guess the only way would be if someone actually takes it from me. And, we didn't even go into the other things like nationalizing mines or just taking it from ETFs or just taking it from pool accounts where there's counterparty risk and you never really owned the gold in the first place. Mm-hmm. There's much more expedient ways for governments to gain a lot of product like that. But they don't seem to need physical gold at all. Right? They seem very clear that they don't want you to own it, and they've spent decades getting you to think I shouldn't be owning it. Mm-hmm. And that's why we have this show to try to help you to understand what money is and how important it is to hold it. And if you've been holding gold for the last 20 years and silver, that you've maintained your purchasing power and built your purchasing power.
Yes.
And if you don't know what money is, then you're going to not understand what the value of anything is. And if you don't understand the value of a dollar, they can take it from you.
Yeah.
And that's already confiscation. So what do you want to do? The number, 1-877-8-SILVER, the website, guildhallwealth.com. More to come on The Real Money Show on 640 Toronto. Welcome back to The Real Money Show. The number, 1-877-8-SILVER, and the website, guildhallwealth.com. Jared, give us a rundown of what was happening this week with Powell.
So Jerome Powell had to testify before the Senate Banking Committee. It was a 2-day, started Wednesday, finished up Thursday yesterday, and much of the fanfare was focused on any clues as to when the U.S. can cut interest rates. Powell said the Fed is not far from confidence to cut interest rates. That's a nice play of words there. They're not far from confidence to cutting rates. So they're almost there. They're almost fully confident that they're ready to cut rates.
I would have thought that it's because they're not confident about the market that they would want to drop the rates.
Yeah, he says we're waiting to become more confident that inflation is moving sustainably at 2%. He said on Thursday while answering questions from the Senate Banking Committee, when we do get that confidence and we're not far from it, it'll be appropriate to begin to dial back the level of restriction. And banks today are looking for that dialing back right now as Bank Term Funding Program. It's ending on Monday, March 11th. Be aware of what's going on with that. That is the commercial real estate pin in that market. That's the pin that can prick that bubble. We have many banks that are feeling it, and it's going to potentially set off a slew of banking failures because the main topic is the reserves that are on these banks. Do we have any capital reserves? What are the reserve requirements for us at the banking system? It used to be 10% as a fraction of reserve banking. Well, since 2020, that reserve requirement went down to 0%. So they have done all of these things.
Wait a second. Banks don't have any reserves?
That's correct. The reserve requirement in the U.S., it was reduced to 0%. They announced that March 15th, 2020. This is obviously COVID height of hysteria and lockdowns. So we need to lower the amount of what you need to have in reserves as a depositor, because we're only allowed to take 90% of your deposits and then lend it out and then do investments with your money. They always needed about a fraction, whether it be 3% up to 10%. It's always been a topic of 10%. But For emergency situations, Jeremy, they dropped it to zero. So this is the major question of how much deposits and why are deposits such a hot topic of today's conversation for these banks? Because they're insolvent, Jeremy. They are simply insolvent. There is not enough to maintain this Ponzi system and control this Ponzi system.
But they're about to end this other lending facility from the Fed, and they don't have reserve requirements. But as you wanted to talk about on the show, they're being told to up their reserve requirements.
Yes, this is
so just a few years ago they were in such dire straits that they dropped it to zero, and now they're being told they have to get it back up to what, 10, 15? What do they have to get their reserve requirements up to?
So this was the biggest push since 2008, with the banking losses and the banking system failures that we saw in 2008. The big hot topic for all politicians and the banking community and the regulators was to implement Basel III rules. Now, according to the Federal Reserve.gov, the proposed improvements to strengthen the banking system because of the failures are estimated to result in 16% increase. So they had to increase the common equity tier of Capital One requirements for all bank holdings. So with whatever holdings you have, everything has to increase by 16%, 20% if you're a major bank. Further, it took value away from once valued assets such as unallocated gold. If you're an entity that had unallocated gold, those will now be valued at zero. You need to come up with more money, 85%, to cover the unallocated gold position. So these banks are totally underserviced, underfunded. These rule changes that are coming out and will be implemented by July 15th or July 2025, next year summer, all of the banks, and this is global, are all the banks ready? And are they ready to be compliant? They're squirming right now because right now the banks are colluding with FDIC to then potentially launch lawsuits against the government to stop your over-regulating. We don't need reserve requirements. Leave us alone. The banks can fail. They're talking about, the potentials. If we do implement these rules, we're going to see banking system failures. The harms the concerns that they cited about the capital rule changes.
Who's citing these?
The FDIC, as well as even Fed Powell. Chairman Powell says we're going to come to an agreement. We're going to make some changes. So it looks as though they're trying to push back on these Basel III rules, but it's not going to work because they're citing the fear factor of it's going to dissuade people from buying homes. The mortgage rates.
The old. If you don't give us the power and let us do what we're going to do, it's going to be a massive crush in the market, and it'll be all your fault. You have to let us keep those keep the percentages very low in the banks because otherwise you'll be responsible for the collapse, not me.
You're right. But at the time in 2020 and beyond that, those requirements were actually the focused upon. They wanted these requirements just to protect themselves from insolvency. Insolvency at the time was so much more important. And then today, fast forward, they really don't want these requirements. They want to drive the banking system into an utter failure, an utter spiral. This is why we're seeing money flowing out of riskier assets into various hard assets.
We do have the great cash out, as they say on Yahoo Finance. Jeff Bezos, Leon Black, Jamie Dimon, the Walton family, they've all sold a combined $11 billion in company stock this month, some for the first time ever. So definitely darkness on the horizon. Why are all these very, very wealthy people and families taking money off the table for the very first time? What is afoot? Let's talk about gold. Is it too expensive at this price? Is it time to get involved? The number 18778-SILVER. The website, guildhallwealth.com. Get your physical. We'll talk about it more on the other side of the break. It's The Real Money Show on 640 Toronto. Welcome back to The Real Money Show. The number 18778-SILVER. The website, guildhallwealth.com. Jerry, before the break, we're just talking about the great cash out. Over $11 billion's been taken off the table by very rich people like Jeff Bezos and Jamie Dimon, the Walton family, and others at this point. And they're pulling their money out of the stock market. And we've talked about the fact that the banks need to get their requirements up, their reserve requirements, that during 2020 they were allowed to drop it to zero. Now they've got to get it back up to 15%. Part of that is to have non-risk assets, tier one assets like gold. And if you have unallocated gold, I guess that would be something like the ETF, that doesn't count anymore.
No.
Either you can hold it or you don't own it, as the Bank of International Settlements is finally coming around to see it Guildhall's way. And the question becomes, is when do the plates stop spinning? When does it all start falling apart? And now we're starting to see the price of gold move, even if interest rates haven't dropped. And who knows who's buying it at the end of the day, but there are going to be bigger moves. Now we're at all-time highs. Does that mean gold is too expensive?
Gold's moved up to all-time highs in anticipation of what it's smelling. It's sensing, it's smelling the Federal Reserve's move. As I mentioned at the beginning of the show, the main key here for us gold and silver observers, analysts, investors, is interest rates. If they hike, chances are U.S. yields go up, gold drops. And when they cut, yields drop, gold pops. So we haven't seen a cut yet, but gold is ready in position. Silver is still a coiled spring. Gold has moved up. We've just under $2,200 today. I'm recording, $100 up on the week. But still, silver is around $24, which is around 90-to-1 silver to gold ratio. Very undervalued for silver versus gold. So markets are in the precious metal sector. They're on the launch pad and they're ready to go.
I'm going to push back a little bit on that. I don't think that gold's ultimate rise really matters with regard to interest rates. I don't think it matters because the debt is $34 trillion. They're adding $1 trillion every 100 days now. We're getting velocity of debt. And I don't think it matters whether they raise it or don't raise it. I think that's talk that ultimately it matters to a lot of people. I'm not taking that away. It significantly matters day to day for a lot of people. I'm talking about what it means to the price of gold.
Yeah.
And when it comes to the price of gold, gold doesn't care whether or not you're talking about interest rates going up. What gold's going to look at is you printed this much money, there's this much debt, gold is undervalued, and where does it have to go before it's of a good value where you could say, you know what, my purchasing power is at a maximum, it would be a good time to sell gold. And we know that with gold because in 1980, gold was $850 an ounce. The Dow Jones was trading at 850 points. That's a 1-to-1 ratio. Gold hit 850. The ratio to the debt was 1 trillion and 850 gold. Gold hit 850 against $52 silver. It's a 16-to-1 ratio. And you could buy a house for less than 200 ounces of gold.
Yes.
Okay. In 2011, gold hit a 4-to-1 ratio against the Dow. The housing was probably somewhere, it was around 500 for an average home in Toronto, so it wasn't really close. And the ratio of gold to silver was 35-to-1. So it was very close, but it wasn't bang on. It wasn't perfect, right? Today, the ratio is something like 17, 18-to-1 against the Dow. It's crazy undervalued against the debts. And the ratio, as you just said, gold to silver is 90-to-1. And these are just some correlations that you can look at, criteria to say, what's the value of gold versus stuff, so I know whether or not it's got good value. Every day, someone comes in the office, say, what's the value of the Canadian dollar? Someone said, well, I know it's moving because I can see that things are pricing different. I said, you mean it's like gender? It's fluid? No, it doesn't work like that. It either is or it isn't. So the dollar is worth what? Oh, it's 70 cents against the US. Okay, what's that worth? No one knows. Don't you get it? That's the point. That's how they rob from you. If you don't know the value of it, then you don't know when you're losing.
Mm-hmm.
You know?
Yeah, that's it.
So gold can tell you that because gold can say how many ounces to buy a house, how many ounces to do this, how many ounces of gold, of silver do I need to buy gold? And every day, Jerry, I'm telling you, every single day, I'm on a chat with Bitcoin, and I ask the same question every day: how many Bitcoin should it take to buy stuff? What should its value be in the absence of the US dollar? And nobody can answer it. Nobody ever answers it. Someone said, well, I wouldn't buy a house with Bitcoin right now. That would be dumb. I said, I'm not asking, can I do it? I'm saying, how many crypto, whatever, how many Bitcoins should it take to buy a house? Someone said, well, you can buy a Porsche in Australia with it. No. I didn't ask, can I buy stuff with it? I'm asking, what should it buy you? Because if I don't know what the value of it is, how do I know when I've got maximum purchasing power? When? Yeah. When do you know? Oh, well, it could go up to 100 grand. Okay.
Yep, this is...
Well, but now I can buy in for $200. So it doesn't matter that it's worth 80,000 because you don't have to put up 80,000. If you did have to actually put up $80,000, you'd be thinking twice about it. You'd be saying, find me something of value. If gold was trading at $30,000 an ounce and gold was at 600, you'd say, give me $30,000 worth of silver right now because that's undervalued. But they don't know what the value is because you've got generations of people who don't understand the money. They think of money as a currency and they don't understand that they're being robbed. I'm not saying you're not going to make a ton of money in cryptocurrencies, which is a unit of exchange, but as a store of value, I don't know what that is because no one ever wants to tell me what it should buy me. What it should ultimately buy me. Yeah. And also, by the way, it's infinitely divisible. And to buy something with it, 0.015, but it's not 0.015 of a cryptocurrency. It's 0.015 against the US dollar that I'm buying in. So it's very confusing. So I always ask, what is it worth in the absence of the US dollar? And how many... What should it be able to buy me?
The valuation.
Few last thoughts.
Yeah, the valuation has not been sought after or found yet. How many Bitcoins would it take? There is no real standard or history to provide us with that. But this is on the topic of de-dollarization. Because of the countries that were holding U.S. dollars, they were forced to make a move away from the U.S. dollar that was infinitely being printed into oblivion. And how does a country manage? So they were forced to de-dollarize and move and find a common denominator to transact with one country with another. BRIC nations normally don't see eye to eye, but they're figuring out a way. Okay, I need a barrel of oil. Well, guess what? I need 2 grams of gold or a gram of gold to equate to a barrel. So we're seeing central banks or in countries such as the Brazil, Russia, India, China, Saudi Arabia already creating standards of how they're going to transact, and they're using gold, they're using currencies, and that is the way that they are combating the de-dollarization trend. And that's the way we have to do it as well. Value your wealth in ounces, value your portfolio in ounces, not worthless central bank fiat currencies, Jeremy.
I agree. Number 18778 silver, the website guildhallwealth.com. Money to be made in all markets. No disrespect. I'm just coming at it from a money perspective of of understanding value with regard to gold.
Disclaimer, Guildhall, we own Bitcoin and we own XRP, so we're not
little bit.
We're not downing the cryptocurrencies, and we do encourage, for people to acquire hard assets with the profits of your Bitcoin holdings. So if you're thinking of taking some off the table, convert and buy precious metals or a natural fancy color diamond with your Bitcoin profits.
The number 18778 silver, the website guildhallwealth.com. Thank you so much for listening, Jerry. Thank you. That was a great conversation. Loved it. Thank you to everyone for joining us this week, and we can't wait to speak to you next week here on The Real Money Show on 640 Toronto.